Mark Lackey comes in every week. Normally we talk about minerals, but once in a while he'll wander into areas like natural gas, which I always think is interesting. Executive VP, CHF Capital Markets, you got a couple of ideas, but talk to me about natural gas, because if you can figure out natural gas, I'd like to know the story.
Well, of course, Pat, I did spend 10 years in the oil and gas industry, so I have some advantage that I've been around natural gas now probably for the better part of 30 years. And people say to me, $4.60 in North America right now, an MCF. Remember, 4 years ago it was $2. So we've had a pretty nice recovery. I think we'll be up in that $5 range probably in the next year or two. But the places that you really get leverage are Asia and Europe. And so we've been concentrating and looking at the Chinese market, where the price of gas trades between $16.50 and $17 an MCF. Same thing in Japan. And of course in China it's there because the Chinese are actively pushing to get more natural gas in their industrial demand, and more natural gas, of course, to create electricity. Because right now about 75% of electricity is coal, and some of that coal is not exactly high quality. So they recognize they have an air quality issue, so they've really been pushing natural gas. But to do that, they're obviously trying to push more supply in their areas, whether it's the South China Sea or the East China Sea. And of course, they're just signed a deal, as you know, with the Russians. Now, that gas won't get to China until the end of 2018. So for those people that think the price may get knocked down in China, it could in 5 years. But I'm not really looking out 5 years.
What about things like fracking? They could change the equation in a lot of places, including Europe, but also China, as I understand it.
Yeah, it could. I mean, they are doing a fair amount of fracking in China right now. Europe's a little more problematic depending on where you are. It's there's some battles, like France has pretty much outlawed it, and you have a battle in the UK. But there's no question, Pat, that more fracking in some of these countries can make a difference. How much tight gas and shale gas they have in China is open to discussion, obviously. I don't know that they've got the kind of numbers we've seen in North America, for example. And plus, they want to go from 2% of their energy mix for gas up to 8% in the next decade. Well, to do that, you need a lot more sources than just probably fracking and or the Russians.
Okay, but here's the thing, my problem with gas, and you're looking at, say, $5 arguably in North America, and 3 times that much in China. Right. And the difference is all natural gas is local.
That's
until
right.
LNG levels the playing field.
That's exactly right. Unlike oil, natural gas is limited by those kinds of constraints. And so how fast will we see LNG get into the marketplace? Well, there's already some in there. I think big LNG possibilities, again, 5, 6, 7 years out. So if we're going to talk about a stock we might like today because of high Chinese prices, it may not be the buy in 6 years, Pat, but I'm only going to look at 1 or 2 years. And the LNG numbers, we know, I mean, look at right now, the pipelines haven't been built in North America, all the facilities haven't been built, and you can't do that overnight. Obviously, you're well aware of the environmental hearings that take place and how long this tends to drag out. Okay,
so when you do your modeling on the companies you're mentioning,
right.
Are they close to China or are they close to North America?
Well, a combination here. The 3 companies I'm looking at today, I got one pick that's going to be shipping into China, one pick out of Azerbaijan that ships into Europe, and I have picked one Canadian player that I think is quite interesting because it's a big wet gas player.
Which one is Primeline?
Okay, Primeline Energy, that's a play we've had on before, Pat. We put it on about 9 months ago at 40 cents, about 4 months ago at 50 cents. We're now sitting at 60 cents. And I'm actually a little bit surprised the stock price isn't somewhat higher because they'll be shipping gas into China with CNOOC within the next month. And they will be getting this very high price. And I'm not an analyst, as you know, Pat, but the 2 analysts that follow this stock suggest cash flow in the next year of 25 cents, profits of around 20. And the stock's trading at 60 cents. So that's a pretty low multiple, given the numbers that are going to be generated. And now all the gas has been laid. The only thing now left to do is do a few tests, and then gas should be flowing, I would say, early July.
Okay. Greenfields, is that the one in Azerbaijan?
That's right. Now, some people have phoned me up and said, Azerbaijan, aren't you worried about the situation in the area given the Ukraine? Except that the president of Azerbaijan and Vladimir Putin have got along well for a long time. I don't anticipate that's going to change. In fact, a lot of the gas in Azerbaijan and oil ends up going to Russia. So there's a tight relationship there. I'm not worried about what took place in the Ukraine is going to repeat itself in Azerbaijan. So I think that the greenfields, what they've done, Pat, they've gone on and taken old fields that were drilled vertically. Well, they're going in and drilling them horizontally with bidirectional and also 3D seismic as opposed to 2D seismic. And they've started to find some pretty good natural gas. And I think this is just the start. They're going to do a lot more infill drilling in the next few years. And the price of gas in Europe, right now, a lot of it's going for between $8 and $10. I think that will hold and maybe even go somewhat higher, given we are seeing the Russians selling gas to China
Potentially
down the road. That's right. And so the offset could be fracking, but unless they change their attitudes in places like France and the United Kingdom, it's not clear to me that there's a lot of fracking possibilities in the rest of Western Europe that haven't already been looked at.
Okay. And then the last one, Perpetual Energy. That's your Canadian one.
Yeah, and I like Perpetual for a couple of reasons. First of all, I like the management team. I know who they are, having been in the management in the business. Secondly, the management owns 25% of all the stock. Typically in these companies, Pat, the ownership's 8 to 10%. So these guys have got a lot of skin in the game. They believe in what they're doing. The third thing is their gas plays tend to be wet gas as opposed to dry gas. Now, wet gas is you don't have a lot of condensate. That's ethane, butanes, higher value products that are trade more like oil products rather than gas products. And their strategy is to expand a lot more of their wet gas properties. So I think this is one that, even at 461, makes a lot of sense. I would say to people, if you're going to buy North American-based gas players, your best plays are to buy wet gas plays when you can get them, because there's much higher valuations.
Yeah, they get extra
Absolutely.
dollars.
It's like owning oil when you have those kinds of condensates.
Wow, that's three good ideas. Good discussion too, Mark.
Great to be here.
Great to have you. Mark Lackey with CHF Capital Markets. When we come back, we're going to talk about this whole Benghazi, Bergdahl, foreign policy in the United States.